Good evening. This is Doc Severson for the Theo Night Report for Tuesday, February 6th. Okay, we've had 3 days of insane volatility. We've been waiting on this forever. We have been cautiously trading to avoid these days because we know what happens when we sell premium in low volatility environments. So we did not get run over to the downside like so many people did over the last couple of days. So in today's report, I'd like to reiterate some of the things that we've been looking at lately and trying to illustrate through these reports and try to show you guys that we sort of saw this coming. Now, nobody is ever going to be able to time these things precisely, but we sort of know that what's around the corner, regardless of the fact that everybody proclaims that it's different this time. Now, I'm going to start with the big correction that we saw back here in 2015, 2016. Okay, this had the same effective result as actually a full bear market. This built up enough energy. This allowed the S&P, and many other markets did the same thing too, at least in this case, the S&P to rest and basically work off the big 2013, 2014 move. So the end of 2014, the mid part of 2015, and halfway through 2016 was basically the S&P taking a big break here through corrective action, building up a tremendous amount of energy. So the eventual breakout from this, the catalyst of which was perhaps the election last year, is something that's driven this up. Now, I believe that this entire rally is more of a secular bull market that we're in. Each one of these is a cyclical bull, right? So each one of these is a cyclical bull. This is the second one that we're in. So with these levels of exhaustion, it's no surprise that we have seen finally some reaction. So that's normally our first clue as we look at the energies for this. And lately we've had to just ignore those because the market's been going higher on this fear of missing out and the final euphoria phase of any bull where normally it goes almost vertical. And that's again what we saw. We saw almost a perfect pattern here. This is a typical S-shaped rally curve that we typically see, much bigger than what we normally see. Again, going from about 2100 almost all the way up to 2900. So almost an 800-point swing on the S&P in just a little over a year. That is amazing. So that's kind of that perfect storm of improving fundamentals, but it's also, again, a side result of the liquidity that's been injected into the market really since 2010 or so. Now, some of the things that we've been calling to your attention are pretty subtle. And so sometimes it's hard to look at these with a straight face. But as the market has been rising lately into January, so January was an extraordinarily strong month. But as the market was rising through the month of January, what we saw was volatility was also rising. So normally those are inversely correlated, but in this case, we had them directly correlated. We had them both rising at the same time, and that is a warning signal, as we pointed out many times. So anytime you see the markets rising and implied volatility rises at the same time, somebody knows something, and this is a good leading signal for future volatility. The other signal that I'll point out here, and this is again very, very subtle, you have to really pay attention to what the price action is doing to catch something like this. But we had some extreme low values of average true range, or ATR, back in October. And so we got single digits on the S&P 500. And so from range contraction like this, or really very mildly trending range like this, comes range expansion. So all of this eventually got unwound to the upside. And again, as the price continued to rally, we started to see ATR get bigger and bigger and bigger up until the final top of this. Now, again, that's a very subtle signal, but what it's showing is almost like shifting foundations underneath a building. You'll start to see cracks before you'll start to see real damage first, and that something is going on here. And you can start to see the daily range of the candle started to get bigger. And so what that shows is more instability. What you'll notice is in a very stable, quiet, and trending bull market, you'll get very, very low volatility. You'll get one initial move for the day, and then that's it. So you'll see fairly low volume, not a whole lot of disagreement in the price, so therefore not as much volume, not as much range of up and down, but that started to change, especially near the end of January. So again, great leading signal, ATR rising, showing instability kind of in between the cracks of the foundation. So now the next thing I want to talk to you about is what happens next from here. So a lot of people have freaked out over the last couple of days. This is very, very normal. We thought we would see a shot across the bow, very similar to this. This actually has been a little deeper than I expected. I expected about a 5% move on the first shot down, then a bounce back up, and then the rest of the move would come on the next swing down. Well, this got it all out of the way. At least there's a good shot that this is going to be the depth of the range, at least for right now, because this is about, on the S&P, this is about 12.1%. On the Dow, this is about 13.5%. Not saying that it can't go down, but right now seems like a good place to start to build up a range. Now, what I expect to see over the next several months, this is kind of like hiking out in the woods and coming across an extremely calm, quiet pond, not a ripple on the water, looking like a mirror, like glass. And then you throw a great big stone right in the center of that pond. You're going to have ripples in that for at least the next half hour as they go back and forth, back and forth. And this amount of energy that comes into a market like this is going to take a while to expend itself. And so what I would expect to see is for the next several months, certainly into the summer, we should more than likely see some pretty good volatility that's within this. So we should see big moving ranges within there. You're going to see rallies, very strong rallies that are going to make you convinced that the correction is over. And then they will flag out up here. Remember, tops are a process, and then eventually bottoms are an event. And this has got to come back down to explore the bottom of the range, maybe even undercut the bottom of the range as well too. Make you convinced that it's all over and this rally has no chance again. Now this condition that we were in was called quiet and trending. Quiet and trending always goes into what's called sideways and volatile. And so we last saw this again, like I pointed out, back in 2015, 2016. This initial correction back here was about 12.46% on the S&P. So we have very similar move, and you can see kind of how difficult this one was to deal with at the time before the Brexit reaction kind of shocked the market out of there. It was almost like those defibrillator paddles that you shock somebody with to restart their heart. This is almost what happened back in the end of June in 2016 to get this market kicked out of the correction and back into quiet and trending again. So that leads to my next point. From sideways and volatile, markets can go into quiet and trending, as we've done for the last couple of years or so, or they can also fall out of sideways and volatile into a full corrective pattern, also known as a bear market. So one of two things will happen somewhere in the next 6 months or so, approximately 6 months. We'll have a lot of volatility, and you'll be convinced alternately that this is ready to break higher from here and assault 3,000 on the S&P. And there will be weeks where you're going to be convinced that the next bear market is with us. So in the near term, we're going to have lots of volatility. We're going to have higher implied volatility. We'll certainly have more than single-digit implied volatility to work with again. And you'll be alternately convinced that this market is either toast or is heading for 3,000 and above on any particular week. This is what gives the market its higher implied volatility because of the additional uncertainty. May we all live in interesting times, and now we can get back to selling premium again. That is it for today's report. Thanks for listening, folks. We'll see you tomorrow.